In this video, I'm going to show you exactly how I would invest $500 in the stock market. So let's cut right to it. Investing does not have to be complicated. If you're new to the market with only a few $100s to invest, I'm going to show you exactly how I would do it. Alright, so the first thing we're going to do here is, of course, we're going to open up a brokerage account. And the choice that I would make here, I think it's pretty clear, especially for small account sizes, is with Robinhood. So Robinhood offers commission-free trading and they have no minimum balance, so it's perfect for small traders. And if you want to learn more about Robinhood, I did make a video covering the pros and cons of Robinhood, why you would or wouldn't want to choose this broker. So if you're interested, check out that video as well. Okay, cool. So now you have your brokerage up and running. The second thing we're going to do is we're going to deposit money into this brokerage account. Now you typically do this through your bank. You set up a payee in there and then you transfer however much money you want to from your bank directly to your brokerage. For this example, I'm going to transfer in $500. Now step 3, which is the most important step, is we're going to actually buy the S&P 500 ETF index fund. So before I talk about this more, why would I choose an S&P 500 ETF versus individual stock picks? Well, the problem is with only say $500 in your account, you can only pick a couple of shares in blue chip companies, and this doesn't really diversify you that well because this will kind of only give you exposure to, just a couple of companies here, a couple of companies there, and your diversification will suffer because if a sector gets hit, for example, technology gets hit in general and you hold shares of Apple, then your complete portfolio will be down for that day. There's no other stocks in there to help you make up those losses. Now as a contrast, if you buy the S&P 500 ETF index, you can actually have exposure to tons of companies. You have Google, Facebook, Apple, some of the biggest companies in the world and the hottest stocks on the market. And this provides you proper diversification so you're not overexposed to any one sector or any one stock. So SPY, IVV, and VOO are some of the ETFs that do track the S&P 500. And yes, you do pay a management fee if you're holding any of these three. But that's kind of the price you have to pay when you have a small account and you want to build that over time. So now I'm really going to open up your mind to what this $500 could become over the span of a few years in investing. So say you buy the VOO and you held this for 40 years until your retirement. Oh, and you don't add any more money into this account. You only have the $500 initial investment and that's all you have in there. So with an average return of around 7% per year, so the S&P returns between 7 and 10%, we're going to go conservative with a 7% average return over those 40 years. You would end up with around $7,500 in that account, minus of course your management fees. So this essentially means your capital over that time period grew from $500 to $7,500, which is a 1,500% gain. Just by buying the index, just by leaving it in there, not looking at it, you just made massive gains in the stock market. Now, if you were able to actually scrap up, say, an extra $500 every single year, throw it into your brokerage account and pick up more shares of VOO, guess what? After 40 years, you would have just over $114,000 in your account at retirement. So if we add in the total amount that you're contributing every single year, that adds up to around $20,500, and over 40 years that builds out to around $114,000. So just think about the potential here just by buying the S&P 500 index. This really is kind of a no-brainer way to retire with a good amount of money in your account so you can live a comfortable life when you do retire. The problem is with a very small account, like say a few $100s, it's very risky to hand pick stocks because like I said, if that stock goes down, your whole portfolio goes down. And if you make a wrong decision there, like a lot of beginner investors do, and you go pick penny stocks or highly volatile stocks, you could literally wipe out your account in a matter of months. Think of the positives here, and one other thing that I want to note is that say you do start off with this ETF index fund and you add money every single year. Over time, you can start pulling money out of that account, funneling it to a second account, and maybe in that account, start investing in more individual stocks as you become more experienced and more comfortable with investing. Sure, you could gamble and buy options. Sure, you could buy, very highly volatile stocks like Tesla, and you could hope that you double your account in just a few months. But that's usually a loser's game and you might end up blowing up your account and ending up with absolutely nothing. you might quit investing, and this could be one of the biggest mistakes you could ever make in your lifetime when it comes to your finances. So if you're new to investing, take a look at this article that a fellow finance YouTuber, Ryan Scribner, actually made. It's completely free and it goes over in detail things you need to know when you're just getting started in investing if you do want to have a more, active approach to your portfolio. If you want a passive approach, you can just buy the index, forget about it. But if you want to learn more, you want to learn kind of the terms that people use, the different methodologies in the stock market, the different mindsets in the stock market, that's a good blog to start reading just to kind of get some ideas around that. So I'll leave a link to that in the description below if you are interested in checking that out. But either way, guys, this is how I would personally invest $500 if that was all I had to start off with in the stock market. But I'm really curious to hear how you would do that. I know everyone's going to have a different approach to this, and I'm very curious to see if you guys would be more risky with your money, or if you're going to go down the same approach I do, maybe pick up some mutual funds, maybe some other ETFs. I'd really be curious to hear what your thoughts are on this. Also, don't forget to join our VIP membership group if you want to see exactly what stocks I invest in and exactly what stocks I trade on a regular basis. Links in the description as well, links to the comment section. But either way, guys, drop a huge subscription if you're new to this channel, drop a huge like as well, and I'll see you in the next one. Don't forget to invest positive.